Good morning, fellow option traders. This is Jeff, and this is the daily scan for Wednesday, December 5th, 2012. Well, yesterday was a interesting day. Not a whole heck of a lot happened, however, but some of the heavy hitters like Apple and Google had kind of a rough day. Take a look at the futures here. Look like we might open slightly up. VIX is at 17.2, and we're going to talk a little bit about that later. So we're going to keep everything else kind of short. And let's see how we going here. Euro and a dollar and bonds and everything are they are what they are, but I'm not going to talk about those today very much. Take a look at the spread account. Everything is positive. I'm not going to do any micro analysis about any sort of early exits or anything like that. I put alarms on everything. You can see over here these little bells tell me that there's alarms on there. I put alarms on the break even. And that way when I look at a chart, let me just give you an example here of Apple. When I look at a chart, no matter where I am on the chart, I'm going to know where my break even is on my current trade, because this alert is going to tell me. Also, I think I'm going to change back to the black background on charts. Everything just sort of pops a little bit extra when I do that. The reason why I went to white was sometimes I thought people might want to actually print a chart, and it did look, I thought, a little bit better in the blog if I had a white chart. But I don't put that many charts in the blog anymore. I prefer to do the videos. So I think I'm going to change back to black, which is going to take a little bit of extra effort because I have to change all my drawing and put them back to defaults anyway, and that's not all that bad to do. If you look at the Profit 10 portfolio, we're looking a little bit down yesterday on some stuff. We're just waiting for those January iron condors to start giving us some money, because there's a little bit of movement, and when you do that, remember the white curve, right? If you look at the white curve, you can see that when price moves, you're no longer at your perfect delta, and therefore you may lose a little bit. Say for instance today, if we lose a point or so on the Qs, here we're at 425, here we're at 355, 341. So you can see that we lose when it wiggles around, but it wiggles around, it goes back and forth, and we're not going to sweat that too much. Just a quick run through of the A+ list. Nothing was setting up yesterday, therefore I believe that there's probably nothing out there today either. Quick peek at Amazon. We have a downtrend. There might be, I'm concerned about this popping above the moving average, so I'm going to just hold back on that particular one. Don't see anything on the long term either right now. Baidu. Let me zoom out in here a little bit. Baidu. Boy, what's going on with this? I'm going to have to change this line up here too. Baidu had a very bad day yesterday. Very bad day. But no entry signal. CF, CRM, or in Chipotle. Downtrend, waiting for this to get up to 80. Nothing on the long-term chart either. Google we're in, MasterCard we're in, Priceline. Priceline, we're kind of flat here. Not excited about doing anything on Priceline. Not seeing any direction there. And not seeing an entry on a long term either. And get rid of this. And finally Panera. Panera is going through some tough times right now. Remember, we had our wedge that we identified yesterday, and it looks like as though we tested it here. We'll see if we drop below here, then that's definitely, we're in a very strong downtrend. And from a long-term perspective, I don't see an entry here, and I don't want to chase. So we'll just keep an eye on it. All right, now I was a while back, a couple of videos ago, I was talking about the VIX and whether or not a call calendar on the upside would be a good idea for VIX because theoretically volatility would increase. If the market went down, the VIX goes up, volatility on the VIX increases. So let's take a look real quick. Let's go to the charts, and we are going to turn off this one. Oh, I already turned it off. Now we're going to turn off this one, and we'll turn this one off. And then we want to add implied volatility. So implied volatility, we will add that. Color looks okay. All right, so let's do the VIX up here. Now, volatility popped up here to 111, and right now the average, and this is what this volatility is doing. Now let me go back here and show you this implied volatility. If you click on this question mark, it's going to tell you it's using a calculation based on the approximation of the Berkson-Stinsland model. This model is usually employed in pricing American options on stocks, blah, blah, blah. So what it's saying is that the overall implied volatility for all strikes in all months, basically, is what it's saying. So this is what you're getting here. So we can see here that when the VIX goes up, so does IV on the VIX itself. And when it goes down, you can see that IV it's almost like a leading indicator in some cases here. But IV's been pretty quiet, but when the price of the VIX does go up, it goes up. So if we were to say we want to do a calendar around 20 on the VIX, and when it is around 20, volatility is up almost 10 percentage points from the 86. If you look over here, this is the 86. This is the current volatility at the current price, which is 17.12. If we go up to 20, where it was back here, if we go up to 20, IV could go up to 105, which is 20 points from where it is now. So if we go and take a look at this calendar that we have in here, that we did the simulated trade at 70 cents, and if it does go up to 20, then we what's the difference going to be in the price if it does that? So at expiration, it's 69.93. Says it right over here when I place. Well, let's just do this. Let's say it goes up to 20. So we'll change this to 20 here. Okay, so now it's telling us that it would be, today it would be worth $10.03, but at expiration, right up here, and we look over here, it would be worth $122 with volatility where it's at. But if we add 20 to the volatility, what do we get? We get 168. 168, reset parameters, 122. So we can see that if volatility goes up, this calendar will become a little bit more valuable. Not as valuable as some put calendars, Put calendars tend to have a higher premium. Puts tend to have a higher premium because there's more risk to the downside. Said this 100 times, you could say it 100 times more. Things move much faster to the downside than they do to the upside. But the VIX moves very fast to the upside, but it's just the nature of the puts and calls that the VIX calls aren't treated volatility-wise the same as an underlying, a regular equities puts would be treated for whatever reason. I don't know why, but there's some sort of reason. So if we have an increase in volatility with the market dropping, and if the fiscal cliff comes, then things are going to get interesting, and this type of calendar here on the VIX would pay off. But I think ultimately, though, the best protection is to go with an ETF put calendar if you want to ensure your downside, as we have done on the Qs, that you can see here. We have 10 put calendars down here on the Qs. Let's reset these parameters, make sure we're good. And right now, it's almost worth nothing. But if we drop down to 52, let's go back here and look at, let's go back here and look at this chart on the VIX. This was on July 23rd. And where was the Qs on July 23rd? July 23rd. The Qs were down around 63. And where is our calendar? It's around 52. So we have quite a ways to go to get back to that July level. But that was not like the worst day for the Qs either. We were all the way down to 61 here in June, and down to 55 back here on December of 2011. So I would still, if you are concerned about the fiscal cliff, I still think, although this fixed trade is interesting, I still think that you're better off with the calendars on the Qs. And this one is a December, January. I would go to January, February, or even February, March with a calendar, or January, March. You can do it that way too, and you should take a look at those. Alright, now, did I have anything else to say about the VIX? I don't think so. For you folks that maybe have an account where you don't have the ability to do like a spread where you sell one strike and buy another, and I know that, like a share builder account that I have for my grandkids, they don't allow that. What I would do is I would just buy a SPY put, and that's what I'm planning on doing today, is to buy a March 13 142 put. It's $6.04 or $604 for it. And let's take a look, just a quick peek at the risk profile here. So if SPY drops down to 130, we'll look at the chart. When was it at 130? That's way down here. It's definitely possible. Back in June of this year, it was down there. So if we go down to 130, double the profit on it. So just another idea, if this is a pretty expensive idea, but the reason why I did the March is that the decay is going to be very slow on it. If we look at March, at that strike at the 142, which is pretty much at the money right now, the theta is at 3 cents a day, basically. So you would be theoretically losing 3 cents a day on this trade. But if we move down, then of course theta won't matter because delta is going to increase and the price of the option is going to increase. You still have that 3 cents of time decay, but the actual value, the extrinsic, will start going up. Alright, so that's it for today. Thanks for watching. Have a great day and happy trading.